All right. Hey, everybody. Thank you so much for joining us this evening. We're excited to present this multifamily investment with my friends here, Francois DeLeo and Wayne Courreges. So most of you already know me, but for some of you that don't, I've had a long Wall Street career. I met my wife the first day of college. We've got 5 kids together. I worked in big law and finance for a while. I started doing real estate about 7 years ago, mostly doing hard money loans for single family fix and flip. And about 18 months ago, I started doing quite a lot more commercial and multifamily deals. And this is one of the ones that I'm involved in right now. I'll hand it over to Francois to introduce himself.
Good evening, everyone. I'm Francois DeLeo. My background is in math and engineering, and I spent the first 10 years of my career in oil and gas here in Houston. Coming from Europe, I quickly saw that real estate prices were lower, so I invested on the side in real estate. One thing led to another, and in about 7 years ago, I just went full-time in real estate, principally in single-family investment. Bought over 200 property at foreclosure auctions. Then I did some hard money loans, and a couple of years ago moved to doing more commercial investment. A lot of them in partnership with Ethan, who's also my personal attorney. And we've done a few land development projects and commercial deals. And we look at a lot of multi-family deal, but this one we do like it. So we partnered with Wayne on that particular one. And
Francois,
yes.
Yeah, thank y'all both for allowing me to present to your friends and your family and others. So my name is Wayne Courreges. I'm with CREI Partners, and I'm going to go a little bit more into my background and obviously this investment shortly. But I wanted to start off with a disclaimer here and just state all investments have risk. This isn't an offer to purchase securities. That will come through the private placement memorandum, which we do have available, and we will share to anyone that is interested after this call to move forward in investing or to learn more. But we wanted to just put it out there that this document does not contain any tax, financial, legal, or any other type of advice. This is more sharing an opportunity, and we would love to have further discussions and also answer any questions. So with that said, I'm really excited about this opportunity for several reasons. One, it's truly an off-market direct-to-seller investment. We found this opportunity through a search of, starting with Harris County's appraisal district, finding, we had a certain criteria, 70 plus units in Houston. And we went to the, got the list of apartments that fit that criteria. And we went to the Harris County appraisal district to find recorded names, went to the Secretary of State of Texas to find the true owners. I used a BIN verified service to find phone numbers and such, and really we just reached out, phone called, emailed, and sent letters. And I remember this particular seller, who is a cardiologist out of Los Angeles. He's owned this since 2007. He saw my text and we had a conversation, and that's about this point about 21 months ago. But it took about 19 months for us to get to a point where we are today. So he was cash flowing on this deal, and long-term owner since 2007, and looking for a change in the chapter that he's looking for. So he called me. And so a lot of that grunt work went in. So there's huge exceptional reason why this deal works. And we're buying it at a good price and not through a broker. No respect to brokers. I love brokers. They bring us deals. But this one's really genuinely unique in that way. The other exceptional reason too, and I'm calling it the diamond in the rough, lost in time deal, is there's huge revenue upside. With the owner owning this property since 2007, he wasn't really focused on getting rents to market. It was just keeping the units occupied to its max and just, having that income. One of the management office, or excuse me, the leasing office is connected to an apartment that he used to, or still does, as owner, live in when he was in Houston. So, when you're, a single owner of a property and don't have other investors to answer to and all, you can do these type of things. So we're going to go into the numbers that really excite me, but this rough and lost in time deal, it's one of those things when you hear these gurus and these people like find these exceptional opportunities that, mom and pop, not real estate sophisticated. And it's not to say he's not sophisticated in real estate. He's very sophisticated. But again, this was not his primary job, just because cardiology in Los Angeles took most of this work. The other item that I love about this deal is location, location, location. So it is in the Galleria submarket of Houston. We're going to go into why and learn more about that submarket if you're not familiar with it. But especially in these times when we're trying to reduce risk and we're trying to find the best deal possible, when you find an opportunity that's off market in an incredible location like the Galleria, it's truly one to look at and be excited about. So this isn't your ordinary multifamily deal. This is not one that I see come across often. It's taken a long time to get to this point. Even more so in this environment of inflationary times where so many investors are getting out of their stock markets or reducing their exposure to the stock and moving over to the multifamily side. You have a lot of money coming into Austin, San Antonio, and Houston just because of the demand of housing. And, when we have these unique, opportunities to find that diamond in the rough and do a massive renovation and get it to market. And when I say get it to market, like I'm not trying to beat market. We're not trying to, set the path. We're just trying to get rents to where they are today. And if we do that, and I'll show those in the numbers, we are going to make an incredible amount of returns and do a really good thing for this community that's just been, it hasn't had the maintenance, hadn't had the capital. So hopefully you'll see that this is not an ordinary deal. So for those that have not invested in multifamily or new to multifamily investing, we are so bullish on multifamily for many reasons. The big is it's a basic human need. At the end of the day, people need a place to live. And this isn't one of the sexy class A, spa resort type apartments. Like this is I'd say a class C, we're going to turn into like a class B property that is an incredible location that's at a great price point that's going to do well if we start getting into recessionary times and even obviously in the good times, right? And those are the type of properties that excite me because from a risk standpoint, I am very risk adverse. I like to sleep at night. I don't like to worry. And this is the type of property that truly does excite me and our investors. When you look at the adjusted return among other asset classes, multifamily has proven resilience and stability and higher returns just over the years compared to office and retail, even in industrial. So, we're able to see those returns. One is it's just because of the short-term leases. If you look at office and retail, a lot of times it's 5, 7, 10-year leases. And in today's inflationary market, if you're getting a 2.5%, 3% rent bump, it's hard to keep up with the returns when, in multifamily, and we'll talk about this on this deal, 14, 15, 18% rent bumps without doing anything. And where are you going to go? Because all the other apartments around are doing it. So I love the returns. And we'll go through our underwriting to show, I'm not, overstating numbers, try to get too excited. But at the end of the day, like it's the returns are better in my research than other asset classes. So cash flow, equity appreciation is a huge reason why, we all love investing in real estate. I'm not worried about Twitter. I'm not worried about, what's going outside. This is a physical asset, that is a business. And this business we can compare to other assets in that area, see what's going well, see what we're doing. This particular property is not a property that we're creating a business plan and not seeing without others having gone through something similar. Those could be a little risky because you look at the market, you're like, I don't know if people will be willing to pay the higher rents. But what we'll see in this submarket is they're doing it. These renovations are happening. They're happening quickly. And so we're seeing, people are willing to pay the higher rents. And through that, we have cash flow, we have equity appreciation. And then there's tax benefits, so passive income is offset by, passive losses, and the passive losses are depreciation. So if you have passive income, doesn't have to be just with this deal, it could be other investments that you may have, the losses from a depreciation standpoint will, that could be offset. I'm not a tax consultant, not an attorney, but those are things that you would want to ask those type professionals. But speaking of why people invest in multifamily, tax benefits is a huge aspect of it. So let me introduce myself now that hopefully I got you a little excited about this particular deal. So Wayne Courreges is my name. I grew up in Austin. I've been in real estate for over 15 years. I bought my first single family rental home when I was 22 while serving in the Marine Corps in 29 Palms. And my 15, I have here 14 years, but I hit 15 on June 18th, managing and operating commercial real estate. My passion and excitement is operating and managing repositions on commercial real estate. That has been what I've done my entire career, is work with owners, institutional and mom and pop and average investors like myself, and develop a business plan, work with people, lead the plan, get all the, be a quarterback, and operate and manage commercial real estate. I have a certified property manager designation from IREM and an MBA from the University of North Carolina Kenan Flagler Business School. I am the host of a meetup, and I would love for you and others who may be interested. On the fourth Monday of each month, we do a virtual meetup, and my goal is to educate and get people excited about multifamily investing. Get out of that herd mentality of stocks and 401k and Roth IRAs, et cetera, and diversify at least a little bit into multifamily in particular. So that's the goal of that meetup, is strictly education, and get people to review and look for opportunities and ask the right questions. I also have a podcast, The Untold Stories of Real Estate Investing. And this podcast is really focused, one, on passive investors for an educational standpoint, but two, realize that real estate is a risk. There's risk in any investment, and there's going to be floods, and there's going to be freezes, and there's going to be, that drunk person who comes and does things. But like, how do you react to that? And how are you insured? And how are you able to quickly recover, right? And that's going back to my 15 years of experience. Like, that is what I've dealt with day in and day out. And so we try to share that with podcasts on our podcast. We get people to get excited and learn more about that. We've got a Facebook group, Texas Multifamily Passive and Active Investors Group. I am a former U.S. Marine, served 2003 to 2007, Eagle Scout, and a member of the Rotary Club of Austin. So enough about me. I want to talk to you also about the two partners that are in the trenches with me in every day, looking at due diligence, construction, and the guys that are really going to be assisting me and Ethan and Francois on executing this deal. So first is Rob Overstreet. Rob Overstreet has over 300 doors across 5 syndications. His assets under management exceeds 200 million. Many of you on this call don't know me, but I'm a man of my word. And I can tell you, Rob is the real deal. He is a great person, hard worker, gets things done. Investors come first. I've been really impressed and worked with them for a long time. Same with Jeffrey Potter. Jeffrey has a lot of experience with 4 million square feet of real estate transactions over his 30-year career. Guest lecturer, a graduate of USC and California broker. Both these guys, I always say it's like being a quarterback, but you're always trying to find people better and stronger and more experienced. These guys bring that to this table. So from an experience standpoint of doing this type of deep value add and these having cycles and showing that, hey, we can perform on these deals, these guys just bring that extra level of expertise we want. So Houston market, it's a market that I've lived in and absolutely love. And these projections here are, among the 25 largest US metros, Houston ranks first for projected total population increase from 2021 to 2025. People don't realize like how we think of the 80s of Houston, oil and all, but go in there now. If you're not from there, you haven't been there in a while, just the medical center, the Port of Houston, the professional sports, the amount of Fortune 500 companies that are, in Houston, and just the massive sprawling, with the education and transportation, et cetera. So very bullish. I love Houston. We're expecting a 11.6 population growth from 21 to 26. Annual rent change year over year has been 7.3. Unemployment rate as of May 21 is 6.6%. Rent gain year over year has been 5%. So these are positive numbers, especially in today's market, where the demand of people as they keep coming, those opportunities to have higher occupancy and having those rents because of that location is key. Couple slides here on just the market accolades. It's the #1 best cities for millennials, according to Langston Company back in 2019. #1 most diverse cities in the US, according to Wallet Hub. #2 metros with most corporate headquarters, Business Facilities Magazine 2019. This #2 top metros for job growth, October 2018 to 2019, US Bureau of Labor Statistics. 3 million number of workers in Houston Metro, just a massive, massive city in population. #5 cities of the future in North America, according to FDI Intelligence. And the thing I love most about Houston is the food and the wine, the diversity, and just the amount of restaurants and just unique places is incredible. So Houston has a global presence, 14 major institutions of higher learning, Rice University, being one, $120.7 billion of top US exporting metro, according with the International Trade Administration. 33.3 million passengers are handled by the Houston airport system, 2 massive airports in Houston, 220 trading partner countries, 90 international consulates, #1 best seaport in North America, #1 best hospitals in America. I was talking to a coworker today, and he's relocated from California, and Houston's where I'm going. If I've with the MD Anderson and the Texas Children's, for my kids and stuff, there's something major. Houston's a place. So hopefully set at least a tone that Houston is a solid city that has massive growth and future growth and more diversified than what has been, over time they've experienced. So this slide here, it's just incredible. And inflation does help with multifamily, right? Housing does increase, and I don't expect housing to increase the way this slide's showing, year over year. And I'll show again the underwriting. But imagine this, over the last 3 months, Houston rents has been 22%. That's on renewals without doing anything, 22% rent bumps. On the T6, the 6 month is 14%. Projected growth for 2023 projected at 4.3%. Now this is Houston combined. There's a lot of submarkets of Houston. Galleria is, by far the best submarket outside the downtown market. And again, we'll go through that a little shortly. But if you got occupancy above 90%, effective rents, have recovered from the pandemic. We didn't see the impact of the pandemic as much, thankfully, for communities and charities and the government stepping in. But with the government, Houston in particular is very landlord friendly. Like anytime we've had to do any evictions, it's been very quick process. They had a backlog there initially, but they've got through it. So those are great things about the Houston market is being a landlord friendly city. So Axiometrics is forecasting significant rent growth for Houston region, with 23 submarkets set to see over 5% rent growth in 2022 and 13 submarkets in 2023. Houston economy's fueled significant demand for multifamily, driving rents, occupancy higher, coupled with higher projected rent growth. So again, this is the Houston market from a macro standpoint. And so now I want to dig in on Galleria, the submarket. So Galleria, the submarket, is this sought after place for high-end shopping with the Galleria Mall. You've got River Oaks and nearby. You have Tanglewood that's nearby. These are multi-million-dollar homes. The Galleria, I used to manage Marathon Oil Tower. It's this tall, I don't know if y'all can see my mouse, but this tall brown building, I would say about 10 o'clock if you're looking at it from a clock standpoint. But right across was that Tanglewood. These are multi-million-dollar homes. You know, Bush Senior, his home was in Houston, was in that neighborhood. You know, average rents, you know, for these higher end Class B, Class A are $1,800 to $2,000 a month. You've got Williams Tower, you got the Galleria Mall. Also, this whole area is called Uptown District. So the proximity that Galleria Apartments has to this economic, you know, think of it like a second downtown of Houston is incredible. It's in between Richmond and Westheimer. So two strong street corridors that's doing a lot of repositioning. You'll see, like, to the left of this picture, you see these newer homes, townhomes. There's newer apartments going in this way. And so a lot of construction renovation happening. Easy access to the highways. 610 is, think of it like the major inner loop. It's like that first inner loop. Houston has 3 belt loops that are literally the highway system, you know. They've got and 610 is that inner one. And that's just right off from the Galleria. I-10, 59, West Park Tollway is nearby. 30 minutes to George Bush International, 20 minutes to Hobby Airport, 15 minutes downtown to Houston. It's located, as I mentioned, in a sought after walkable Galleria area, minutes from restaurants, shopping, schools, anything you need, you know, it's in the submarket. So a little more info on this, the submarket. Mentioned that there's a lot of businesses, like the second, you know, I think it was like the second downtown of Houston, but over 84,000 employees, 2,000 companies, just massive submarket. It's one of the largest U.S. business districts outside of a historic core, 14th largest business district in the nation, more than 26 million square feet of commercial office space. So when you think jobs, you know, especially being close to your home, you know, there's a lot of opportunities there. Second most square footage of Class A office space, over 16 million behind downtown Houston. Just mentioned earlier that, you know, this is, think of it, the second downtown of Houston. We've got 0 deliveries of multifamily units expected through 2023. So new competition, it's not, and especially for, you know, this demographic, Class B, you know, a lot of the newer developments that are happening are Class A, high end, 2,000 plus in rents. So one of the things I also want to point out on the slide is the city of Houston is doing improvements along Richmond Avenue. It's the Richmond Avenue Public Art Project and St. George Place redevelopment plan. Millions of dollars is being put into this street. And it's incredible. The artwork and such that's going on, the sculptures on that street. City of Houston would not be putting in millions of dollars into a street if they didn't believe this little area was going to just continue booming. Our property is going to benefit massively from the city of Houston's development. So we talked a lot about Houston macro, where the rents like 5%, 4%, and you'll see in my underwriting, I've kept in line with that. But the Galleria submarket, the annual rent growth is 22%. You know, the median income is 62,000. Now that's for the whole Galleria area as well, 45,000 closer to where this property is. But for what our rents and what I'm gonna show, it's easily achievable with the 3 times monthly rent or monthly income requirement we have. Projected rent growth 4.3% in 2022. That's, you know, sometimes I think a CoStar and Yardi Matrix and all are just so behind because, you know, one of the things I'm gonna show in our underwriting that I'm super excited about is like year 1 performance has already been hit. You know, they're already leasing 1-bedroom apartments for $955. And right now it means nothing because we haven't gone to that spreadsheet, but the rents are there. It's 14% at least from prior renewals, et cetera. So these projections are conservative, but they're still extremely good. You know, post or prior to inflation, prior to COVID, we would be happy with a 4% rent bump. And so hopefully, you know, just, you know, get you excited just again about the Galleria submarket. So I mentioned that Houston has this inner loop 610. You sort of see where the 6220 Fairdale Lane wording is here. You see that inner loops, that's 610. And so I'm going to push play, and Google Earth is going to take us. Now, I also want to mention north. Think of it, it's going towards like your 9 o'clock, down where you see the Woodlands and Conroe. That's north here. So where the gallery is located, this is West Houston. All right. One of the first things I do when I'm investing in Houston is I always go to the FEMA website. When brokers and everybody sends me anything, I really want to know. If I don't know where the location is, I'm going to the FEMA regardless. Galleria Apartments is not in the 100 or the 500-year floodplain. It did not flood during Harvey. It did not flood during the Memorial Day flood that I had to deal with on other properties. There was the tax day flood. I mean, Houston has its share. I mean, it's a massive city with a lot of concrete, and the water just really didn't have a lot of places to go, right? But the Galleria Apartments and hasn't had any flooding, hasn't had any insurance claim, so I was super excited about that. Again, trying to reduce risk. If I'm near these bayous or anything, that has really concerned. But I manage, as I mentioned, a high-rise office in Galleria, and I can tell you the Galleria does extremely well on just being higher elevation and having that water control. So I wanted to put that out there because I know that's going to be a thought for some that are looking at Houston. So let's talk about the community. We talked about Houston from a macro. We talked about Galleria, and now let's talk about Galleria Apartments. So Galleria Apartments has one on-site property manager, has 2 maintenance. All the HVAC units are original. I mean, they may have one-offs that have been newer. The roof is in extremely poor condition. You've got cast iron pipes underneath the apartments that have corrosion. You've got a swimming pool that looks like green. You've got a fitness center that's closed because the equipment doesn't really work, and it's a safety issue. I mean, the list can go on and on and on. And I love that. Like, that is great, for a location, a property, and finding an opportunity to go in and do a renovation and to get this property, this community, the love that it needs is exciting. So what we've done is we've gone in and hired a third party, AEI consultants, went in, did an environmental, did a property condition assessment. We walked every single unit with our property management company that I'll talk to you about shortly. And we came up with our capital plan. And this capital plan includes replacing the HVAC units, all of them, all 101. And the ones that haven't been replaced in the last couple of years, but for budget's 101. We're going to go in and do a full recoating of the roof. We're going to go in and take care of the pool, do part of the gazebo. Next to the pool, there's a gazebo area. There's a picture of it later on. We're going to add a playground. We're really going to make this a true family community, and with that pool, that gazebo, grill area, and the playground. There is a storage unit that's full of stuff. Like, it just needs to be completely cleaned out. And the thought with that room is to do like a community room. And so super excited about that, because we're going to be changing a lot of the renter base and having more family, more just nicer facilities all around. So that way it's going to allow us to just continue getting up to the market. Again, I'm not underwriting even surpassing the market, even though I feel like we will. But there's this huge opportunity to do it. So, there's ample parking, there's the clubhouse, there's a courtyard, outdoor grills, but really I'd love to with y'all. If anyone wants to reach out to Ethan and Francois, and have, we can tour, but you are owners in this property that needs a lot of work, but this work is being done by a strong local team, and we're well capitalized to do this. So it's exciting. This is where we make a lot of money by taking on projects that are already leased pretty high, like 95% leased, and go in and do renovations to match what the Galleria submarket allows, and go from there. So mentioned 101 units. It's a mix of 1 and 2 bedroom. Many are, we have that urban community amenities that the submarkets prefer. There are several unit of the 4 rental plans. There's 2 that really allow for us to do a washer and dryer option. Right now, it's a community washer and dryer laundry area, and that's going to be still stay the same. But we're going to be able to go in and add washer and dryers to a couple of these floor plans. But here what we see is, I mentioned earlier in this presentation that the owner goes and stays at the one of the units, which is connected to the management office. So that's this unit here on the top left. This unit here is, I mean, it's hard to like when you go after deals and you find like, hey, this unit, this literally unit 101 isn't being leased because of the owner there. That's free money. That's like day one, we go and rent this unit, and we rent it for $11.55 a month, and that's massive revenue over a year basis. Now next to that, you'll see the management office. It's the top middle one here, and you see that door there. So beyond that door is that apartment. So we'll wall this up and make this truly a leasing office, right? So some of the restrooms, one of the unique things about the first floor of these apartments, or 6 buildings, is they have patios. So as we, look to find additional ways to raise revenue, like this is extremely desirable in the Galleria to have a private patio that's fenced. So looking at that, laundry facilities, we've got about a year left, a year and a half left on washer and dryer contract. We've got money to go ahead and replace those washer and dryers on our ownership, and all the money that goes in there, it goes to the returns to you as our investors. Covered parking, as an example, $25 is what they charge for covered parking, but everywhere else around it's $35. So that's an easy change. A lot of this low-hanging fruit that's not going to take much to do is what we're going to be able to offer. So I always mention this true deep value add. So, this project, as mentioned, hasn't had any major renovations. Our lender asked, like, what's been the capital spend for the last 3 years? 0. So, that is exciting, for the Galleria. It's hard to find these deals. You'll find as you get more into the multifamily investing, a lot of these deals, they'll do a value add, then they'll sort of flip it to other people they know or groups and all. Like this is like, stuck in, going back to the Lost in Time deal, stuck in 2007, right? So we're going to go in and do this massive renovation. I talked about several of these, but I want to just hit it again. One, we're going to rebrand, name, website, monument signs. There was a picture previously that monument sign was in good shape, so let's take out the interior of that sign, replace it. It has uplighting. We're going to go in and this painting, you'll see this facade has shingles. That's going to be replaced with some architectural shingles. We're going to repaint, update the landscape, the amenity areas, mentioned the pool, renovating the pool, getting the gazebo extremely nice so that there's nice community space, getting that playroom, that community room, add that playground, all part of the renovations that we expect to have over the first year and a half or so. Aggressive renovation, 81 units in the first two years. These units, because of the location, will lease practically as we renovate. It's what we're seeing in the market. Now we do have vacancy underwritten, but I'm very confident that when we go in and we do the roofs, we do the HVACs, we do the exterior, I mean, you can just imagine just the transformation of this property. People are going to be excited to come to this property or renew, and if they renew at the higher rates. So, our renovations on the interior are vinyl flooring, new carpet, 2-inch blinds, paint cabinets, upgrade countertops, install backsplash, and replace appliances as needed. As we went through each unit and did our, inspections, a lot of the units already had the black appliances. I budgeted about $7,500 per unit for upgrades. When we went through the inspections, I still kept it from an underwriting at $7,500, but about $1,500 of that $7,500 typically goes to appliances. So those are savings that we'll have and extra buffer for units that may need a little bit more love and care. So this is important. Y'all can trust us, Francois, Ethan, myself. We've got a strong team. At the end of the day, what matters is the people who are going to be there day in, day out. Now, I'll be there weekly at minimum. I will be there on calls and on call asset management. Our team is, going to be heavily involved. We're investing just like you. So we're eager to get this deal and get it done right and quickly. But it really matters on who our property management. So Tarantino has $2 billion in assets under management in the United States. They are based in the Galleria. The property management company is going to be fully integrated with the construction management company. So it'll be a different division within the company, but they will handle the construction. And the reason why I decided to do that is so I don't have the property manager and the construction manager button heads, right? And then they're all both incentivized to get the job done as quickly as possible. The other thing I love about Tarantino is they're massive. So the economies of scale with the HVAC units and the roof coating, et cetera. Like when we already have pricing for these items, and they came to the property, these contractors and vendors, because of their experience and their relationship with Tarantino. So super excited for them. They are a group that over the 21 months or so. I brought them in initially when I first underwrote the deal, 21 months ago. So they're super eager, and again, based out of the Galleria submarket. Nobody better, in my opinion, than Tarantino to manage this for us and do it right. So some rent comparables. We've got the Galleria apartments. Notice here, $1.26 for a 1-bedroom per square foot. From a size square footage, each apartment that we're going to be looking at is going to be a little different. So what I like to focus on is the rent per square foot. 1 bedroom for Galleria is about $1.26. This effective rent is about $817. They're doing deals today at $955, and I can show you leases that they're getting that. This 2-bedroom at $972 effective rents. This averages all the existing current rents. We're getting $1,100, $1,155 for the 2 bedrooms without us doing anything. They're renovating they're renting at the higher levels. Inflation's in our favor, which is great. But we're seeing already a higher per square foot. But let's just say $1.26, $1.02. So the total average on this is $1.14. This is where I get excited. So Heritage Apartments, $1.32 a square foot. You look at Montebello Gardens, $1.47 a square foot. $1.50 1 bedroom, $1.45. Like we were $1.26 and $1.02 for the 1 bedroom and 2 bedroom. The Chateau Dijon is $1.26, $1.09. We've got Park at Voss, $1.35 a square foot, $1.40. The Ridley. Now on the Ridley, if anyone knows this area really well on Green Ridge, like this is a perfect comp. They came in, similar age property, similar doing, and they're getting $1.66 a square foot on 1 bedrooms. Like if you go to their website and look at what they're renting for, this is what they're getting. 2 bedroom, $1.50. So the average is $1.58. Yorktown apartment homes, $1.26 total average. So the 1 bedrooms, $1.31. All this to say, it makes sense. This owner has owned this since 2007. His priority has been just to keep things leased 100% or as close as that as possible. So if we're at $1.14 average rent, if all I'm trying to do is just get to market, and I'm not even having to get to $1.36 a square foot here, but if I just get to market, we're even going to exceed our projections so much further. If I just get half, like hell, give me to $1.25 a square foot, we're going to be doing extremely, extremely well. One of the questions that I've received prior is, why aren't you comparing yourself to like Constitution Square, or why aren't you comparing yourself to the property next door? Well, we're putting in $2.1 million into renovations. We are comparing ourselves to these other properties. I'm not going to be comparing ourselves to the properties, right on the corner. That property is going to be the next property that we're going to be buying, and that we're going to be talking to you all about. Like, that's the excitement. That's what we're going to be doing. So if you know these properties or see these areas, they're already case studies. They're already doing this and at the rents, and we're coming in because of our relationship with the seller, buying it, capitalizing, and pushing rents. So deal breakdown. So the overall 16.4 million, total loan is going to be about 10.6 million. Investors equity is 5.7. So that's the sources of the funds. Use of funds, site acquisitions 12.65. That comes about 125,000 a door approximately. Cost to build 2,280,000. In this cost to build, I've got about 400,000 in contingency. And acquisition fee, we've got 379,500. Loan fees costs 722,800, and contingency reserve 440,000. So within this cost to build, we have, as I mentioned prior, proposals and the inspections done. We know day one what we're going to do, right? And this loan fee cost, part of that is the rate caps. And one thing that we've done already is we've locked in our rate at 4.5%. That's probably going to be a question, so I'll get to it now. 4.5% is our rate. Now that's a fixed part. Because it's a bridge loan, we also have a 30-day SOFR. Now that 30-day SOFR, our underwriting, I'm happy to go through our underwriting. Love numbers. We've stress tested around 7.5%. So there's this Chatham financial modeling, which is more like the industry guideline for people to go in. They can see what rate caps are, but they can also sort of see what the forward curve, like what's the projections? What are the projections? And I think everybody on this call and others can agree, rates are going to go up. It's a matter of, it's just going to happen, right? But at some point, and what the markets and what people within Chatham Financial and all believe is that about end of year two, rates start going down, right? And so we have our model stress test at 7.5%. But as I mentioned earlier, I like to sleep at night. I'm very risk adverse. We're going to be buying a rate cap. And so within the 722,800, we have a large amount of contingency to buy that rate cap. And it's quite expensive, but it's expensive. But it allows us to protect our investor capital and make sure we're not losing sleep, because as rates go up, our mortgage payments goes up, right? So feeling very comfortable on that, and we can definitely dig in more on that. Now let's talk about the 3-year pro forma. So this is a screenshot from my underwriting. Happy to go through it with anybody. Just work with Francois and Ethan. We can schedule a time. But line 1, annual rent growth, I did 5% year 1. Year 2, 4.5%. Year 3, 3%. Okay. One of the things I like to do is I always like to tell our investors, again, I like to sleep at night. So I always say, like, hey, get excited. I'm going to tell you the return shortly, but I'm like, get excited about this return, because if you're excited about this return with my extremely conservative underwriting, you're going to be extremely happy at the end. So this annual rent growth, 5%, 4.5%, 3%. We're already seeing 14% or more at the property, right? But it doesn't matter what that is. Let's be conservative. 5, 4.5, 3. Okay. Other income growth, 1%. 0 year 1, year 2, 1%, 1%. It's like nothing. I mean, we're going to have other income growth just off parking and laundry, et cetera. But let's just be conservative. Other operating expense growth, 2%. So that's through properly managing the property, bidding the services, and just managing it efficiently and effectively. So we put 2%. So that's pre-market. So current market rents, put it there. We did gross potential rent Year one at 1.2 million, a loss gain to lease negative 12. So if you look at the vacancy and you add this up, so 8, 9, 10, 11%. So they have never been below 95%. And I can show y'all separately on, we've looked at the last 3 years of on a monthly basis, but they haven't been below 95% from an occupancy standpoint. Now, has it dipped lower below because of collections, et cetera? Yes. But even then, it has not gone less than, a 10% economic vacancy. So we keep it around that 11%, feel very confident with the amount of work that we're going to be doing that will achieve that. But I've kept that pretty in line with year 2 and 3. So I'm not being over bullish on, hey, we're only going to have 1 or 2 units, right? Vacant. So give it some conservative underwriting on our vacancy. On our RUBS, this is where I'm even adding a little bit more. So the thing about this property is they do a fixed water fee. So at other properties, think about it, they do like a pro rata share. So if the pro rata share, or say the bill comes in 8,000 and someone has, 2% of that, they pay, that's their pro rata share. They pay that, whatever that number comes to. So here they do a fixed rent or a fixed fee, and it's extremely low. So what we're going to do is go in and we're going to truly reimburse utility billings, rub the property where it's a strict pro rata, but I'm doing that over 3 years in this. And that's what this is showing. So this is where this number is growing. Over 3 years, we're doing this. That's not just happening day one. Like when we get a new person that's signing up on our lease, like they're paying their pro rata share of water and pest and all these other, utility billing expenses. So this is one way that I've just stayed conservative. It's like, hey, let's do it over 3 years. Maybe market does get really bad. Let's be conservative. So this is, again, me sleeping at night. But this 137,000 in RUBS income, I really expect that to be year 1, 1.5, if not no later than year 2. Other income. The only thing I did in other income was parking, bumped that from $25 to $35 because that's the surrounding. And then I did washer and dryer for a certain amount of units. And I did that at $25 per washer and dryer combo. And I know that that's at least going to get $40 because that's at least the market. But I'm like, hey, let's be conservative, $25. So that's other income. There is no application fees in my other income. There's no late fees in my application. There's no pet. So I'm being extremely conservative on my other income. And I'm doing that, again, just to give us a lot of comfort and room that, hey, we're going to be happy with a certain return, and we're going to be a hell of a lot happier when we, are able to, get higher rent growth and faster RUBS and other income. So let's talk about on the expense side. So property management is 3.5%. It's based on the management agreement. G&A 150. A lot of these are general standard and multifamily. They base it off units. So in this case, G&A is 150 per unit. Contract services 125. Now we will have 2 maintenance techs on the property. And so a lot of the work that they'll do is they'll assist with the pool and the any HVAC type repairs and stuff. So our contract services should be pretty light because we do have a certified electrician and HVAC qualified person as well. So marketing, going back to that unit, it's about $100 per unit. Payroll is $13.50 per unit. Repairs and maintenance, I bumped that down. A lot of times that's around 400 a unit, but if we're going in and replacing all the HVAC, we're doing the roofs, we're working through cast iron repairs, this number I think is likely going to be a little less even. It may sound crazy on an apartment like this, but when you're going in and doing this type of renovation, I feel very confident that we have some buffer here. And then we got turnover costs. So between R&M and turnover costs, about 400. But remember, our turnover is in our capital budget. We're going to be doing 81 units on our renovations. So again, this is just added buffer. Insurance, 700 a unit. This is what our insurance broker, who's focused, for anybody that's familiar with the insurance group, it's Fitzpatrick, that we're using. And all they do is just focus strictly on multifamily. Real estate taxes, we use Morrison and Head, and we'll fight our taxes aggressively each and every year. But they gave us a worst case and a best case, and we average it in the middle. But I feel very confident in this. We've got a 10% year one growth, 5% year two. And again, we'll fight that. We have replacement reserves. This actually should be zero. This, with the bridge loan that we're doing, we're in the amount of capital, we don't need replacement reserve. So this is an additional 25,000 that's just sitting here, on this slide, but there really should be zero. So that's even additional more buffer return. So net operating income year one, 554,000, 739,000 year two, 821,000 year three. So anticipated returns. As I said, if you're excited or you get happy about these numbers, you're going to be extremely happy on, as we execute the business plan. Remember, this is a 3-year deal. This is us going in, doing a massive renovation over the first year and a half, re-tenanting it, and then we're sellers. Like, we're looking at, this is an equity play, right? So investor IRR 17 to 19%, equity multiple 1.6 to 1.9. You might look at that 1.6 and they're like, that's a little low, but it's not, because it's a 3-year deal. Most deals are 5 to 7 years, and they're like 1.8 to 2x. If I can put in 100,000 and get 160,000 in year 3 and have tax advantages and not worry about Elon Musk doing a Twitter tweet and hurting my stocks, like, this is exciting. Like, I'm excited just talking about it. Preferred return 7%, average annualized return 20.7%. So those numbers are based on this revenue and expense. 5% year one growth, 4.5% year two, 3% year three. I can sleep at night feeling like we can get to this 1.6 equity. Let's be happy with the low, 17% IRR, 17%. And, as we execute the deal, like I know we will, and have the right people, boots on the ground with Tarantino, we're going to be able to, push this. Let's do a 2x in 3 years. The way the market and the location that we're doing, we're going to get it. So the deal structure, I also we didn't really touch base on that. So I'm getting a little excited here. Deal structure. So we'll do 70%, 30%. So 70% are limited partners, 30% are general partner split. So 70-30. We don't, from a general partner side, get any split or equity until you receive at least a 7% preferred return. I'm not seeing this in many deals lately on these preferred returns, but from an investor standpoint, our goal is to make you money first, and then we'll make money, and then you'll reinvest, and we'll grow together. After the 18% IRR, it's split 50-50. And the reason on this is because it keeps us motivated. At the end of the day, you want your sponsor and you want your team all motivated. We're all making a lot of money together. So that's our deal structure, and feel like it's extremely exciting, especially in today's market. Now, let's talk about cap rate. Now, the Galleria submarket cap rate's about 3.5%. Really, you ask brokers, everywhere in Houston's like 3.5%. It's just crazy what values are going. But Galleria submarket is actually strong 3.5%. I think that's a good rate all day long. Now, we've bumped over a 3-year hold at a 75 basis points. So we're underwriting at a 4.25% exit cap. Talking to brokers, talking to other investors in the Galleria submarket, the number 2 downtown of Houston, that I don't see us getting in the 4s, but let's be conservative. Things happen, right? So we're at about that 19% IRR. But what if it's 4.5%? Maybe we go up a 1% on the cap rate and the Galleria. I mean, we're still making a 15% IRR over the return. Now, this is not a cash flow deal. We're putting $2.1 million into the property, and we're renovating. We're doing grunt work, like we're getting this property repositioned. With that, we're releasing. We're our tenant base will be changing, and so as we rent and we pay our debt service, et cetera, and implement our capital strategy, the cash flow won't be there. So I want to make sure that's understood. The positive news of that is we're well capitalized if things get tough. We don't have to do the full 1.6 to 2 million project when we're already getting 14% rent gross without doing anything. So from a capitalization standpoint, we're good to go, but we're not negative cash flow, in year 2. Like year 1's like 15,000 negative cash flow. And again, that goes back to like 5% rent gross, 4%, 11% vacancy. So feeling very positive and optimistic about it and our team to execute the deal. If we stay at 4.05% exit cap, I mean, at a 5% rent growth, 22.79. At a 7% rent growth, which is still half of what we're seeing today, it's a 28% IRR. But this is illustrative purposes. I just feel like it's good to sort of see, what we can do. Obviously, if the markets stay around 3.5%, there's a lot of talk that cap rates aren't really in line with interest rates, especially in these strong markets with high demand, a lot of people, and housing, the shortage that's going on. Time will tell. But from a worst case scenario, from my underwriting, I hope y'all see that, we're staying conservative. So Galleria investment timeline. So April 1, we went under contract, went through a lot of due diligence, got our lender. Ready Capital is the group that we're working with. Fantastic lender. We have weekly calls with them. Due diligence happened over about April 12th, middle of April. We're having this investor webinar today with you. PPM is available. Ethan and Francois will provide the investor portal where you can go in, review the PPM. That investor portal is a one-stop shop. You go in, we do monthly updates. You'll find your K1s there. You'll see, your PPM documents, et cetera. That's where you'll sign and all. Investor funding, we're looking at the next 15 days. We're already close to 70% of capital raise. So we're this week alone, we've had about 800,000 in investment. So we're looking really good, very excited to close on August 4th. So I just ask that y'all, if you are interested, get with Ethan, get with Francois very quickly, and realize that funding is going to be pretty quick because we got a closing of August 4th. I put in here anticipated sell date is August 1, 2025 to August 1, 2027. And I did that on purpose. So the loan, the plan is a 3-year hold. But I'd like for everybody that's listening to this webinar to realize that markets can change and we have to be flexible. So let's think 3 to 5 years. Know that we're all motivated to ready to sell at year 3 or less. But I also wanted to talk about the loan. So the loan I mentioned is that 4.5% plus SOFR. We'll have a rate cap. So we're going to be comfortable sleeping at night. But we have a 3-year loan with 2 1-year options to extend. Okay. So we have flexibility. The other thing that I always like is that DSCR, debt service coverage ratio, year 2, we're at 1.25 and higher. So we're able to, if needed, refi, cash out our, put cash back to our investors and then hold. So there's different strategies, but no, the plan is that 3-year. So I only got a couple more slides here, but this is a 506B offering. So you all are either accredited or you all know Francois or Ethan in this investment. But this investment allows for accredited investors, and accredited investors are those that are single and make 200,000 in annual income, or married 300,000 or more, or have a net worth of $1 million. So if you meet that, you're accredited, you can invest in this deal. The other is sophisticated. You do not need to be accredited in this deal if you have a prior relationship with Ethan or Francois. So that's huge, because there's not a lot of 506B offerings that are being done because you can't advertise, and so that's something that is very unique to this deal, and I'm excited about because more people can have the opportunity to grow wealth through real estate through this type of offering. The last slide here is if you're interested in investing, please reach out to Ethan, reach out to Francois. But if you pick up your phones and you just use the camera and you do the QR code, just put in your info. So I'll send that to Ethan and Francois so they can reach out to you. I'm available as well, but want to respect relationships and want to make sure that y'all are being taken care of and getting all your questions answered. So with that, I'm going to turn it over to some questions. So we had a question here. How many 1-bedroom versus 2-bedroom units? Embarrassingly, I'm going blank on that, but I'll get that info to you. There are more 2-bedrooms than 1-bedrooms, which is great, but we'll get that to you. It's pretty even, but we'll get that. So one of the questions here is, how do you expect to get your performance numbers higher than the current actuals? So again, I did worst case scenario underwriting. The way we get even better performa is we make sure we work with Tarantino, that we're charging all the market rents and miscellaneous income that we can. There was one at Ridley. If anyone goes to the Ridley Apartments or investigates, they do an amenity fee. It's I believe $30 per month per unit, and that gives them access to the pool and other amenities. But that is market. That's what we're starting to see in the Galleria. So we're just looking at other income. I mentioned the laundry in the laundry room, changing out those washer and dryers, all those coin machines. That's money in the bank for us. Once we change it, that's not in our underwriting. So we'll look at that, and then, obviously market and renovate as quickly as possible so we can push these higher rents. How does raising the interest rate affect your evaluation at entry and exit? So our entry, we have it at 4.5% plus the SOFR rate. And on our underwriting, and again, I'm happy to share it, is we did the 4.5%, and then we modeled our increases on the SOFR based on the Shatham financial modeling, right? So we didn't make up this numbers. We used an industry standard. And so we went along that. Now, remember, our capital isn't going to be day one. As we renovate, we're going to be doing, paying for it, submitting for loan reimbursement. And so that loan will get bigger over time. So over 1.5, 2 years, the mortgage will get bigger as time goes on. But, from an underwriting standpoint, our rate cap, again, we feel very comfortable on that. Can the market support the rent increase after renovations? That's a really great question. And absolutely. I mean, we went back to those comps. A lot of those properties are within half mile. I try not to go anything past 1 mile because it gets a little, unless there's no other apartments, maybe you go out 1 mile. But there's a lot of apartments that are doing similar work that we're doing that are within that half mile and doing it. So absolutely. The average income is about 45,000. So if you take the three times your rent, we're still able to get to that 1,100. Now think about it. I mentioned those new apartments in the Galleria of 1,800 to 2,000 or more. We're at $1,100. Like if I get $1,155 rent for that 2-bedroom, like we've done extremely well. And that $500, $600, $700 gap, like if we've done this major renovation and the market's turn, people are going to look to save money, but still be in the same area. So I feel really good about that. So from comps for several complexes in the area, Tiffany Square would be one, Constitution Square. I don't view them as comps. Today they're comps, but they're not comps after we do these renovations. So think Ridley, think Galleria Flats, Montebello, think of those similar age buildings, but have gone through these renovations. So the construction budget, I think I went through that a little earlier, but yes, I'm happy to be as transparent and we can go through the construction budget for anyone that's interested in that. But within that, we have the contingency, and then these are also based off Tarantino and bids that we've received. I don't know what a GMP cost plus is. If you're able to clarify, I'm happy to answer. And it looks like we got someone from Houston there. Thanks, Mark, for being on. Any other questions that I can answer? Francois, Ethan, do you have anything you want to add as well?
I think the question on construction budgets you answered. I think you have a fixed quote from Tarantino. It's not a cost plus where they would
Great question.
Just charge you as they go.
Yeah, they charge you as you go. So it's a 5% construction management fee. So that's in our numbers. There are things they'll do in-house for us as they do like the turnover changes. They'll do that in-house. They've got a crew that does that. But from a plumbing, roofer, those are their preferred partners. And I'm all about 3 bids, and we'll get bids. We'll make sure that we have the right group. I don't always go with the low cost, because at the end of the day, I want to make sure that when they can do the work, when they say they can do the work, but they also look from a risk management side. I think it's something can be underlooked, is making sure they have a high safety track record as well. So yeah, it's a great question. So it's 5% of that, and it's 5% of the larger items as well. So you'll see, if you want to go through the construction budget, we can, but it's not 5% on everything. It's the HVAC replacements, the roof, the ones that take a lot more coordination. Good question.
Sure. Just like to rebound on one thing you said, Wade. So a lot of I manage 80 single family rentals. We used to have an entry point 1,200 and our comfort zone being 15 to 1,700. That has moved up tremendously. Basically, I don't have anything below 1,500 nowadays, and it's really the 1,800 to 2,000, and we're really pushing towards the 2,000. So I review tons of multifamily deals all the time, and often it's very hard to see the value add because the rents are already pushed. They're telling you, I'm Katie, there's lots of new construction, I'm still going to push, but what are you pushing against? People are already up and you have a lot of new build competition. In your instance, pushing to 1,200 from 1,000 roughly, or 900 to 1,100, it's totally different. There is no affordable housing in Houston generally, but even more so in the good location. So that's one thing I really like about this deal, is people that can pay 1,000, they can pay 1,200 if it's a better product, and they really don't have a choice, because most of the new construction is way more expensive, and let alone going to a single family. It used to be at 1,200 would get you in a single family. It's really no longer the case. So the value add here exists. And that's usually where I have trouble when I review other deals right now, is it's less convincing, whereas here it's really crystal clear in my mind.
I'm just extremely grateful for the opportunity to share this, and hopefully you saw some excitement and stuff, because I think it to Francois's point, it's a diamond in the rough. It's a lost in time deal. You're not going to see, you just don't see this as often when we start looking for opportunities out there. So again, if y'all do put in your information on this QR code, I will send that to Ethan and Francois and make sure that y'all have as much resources and time and transparency into this, and go from there. Appreciate the partnership.
Thank you, everyone. And any further question, contact us directly, of course.